But growth isn't even what you're most looking at here.
Correct.
It's paying off the mortgage and the money coming out.
Right. So now the money's not going to a mortgage. It's going to you, the investor, for eternity.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds. Good to go. Do you know why they do that?
No idea.
Do you know that thing at the movies?
Oh, yeah.
That it's to sync up audio with
the video.
Oh, I had no idea. I was just thought they
We're
just
recording
did that.
this on one file though, but on the movies they do audio and video differently. So then they sync it up to the
unless the computer audio goes bad.
right. Then we
and
have to use this one.
Then this has actually 3 tracks of audio. And
Yeah,
I have to
each
sync them up.
individual.
Oh,
Yeah, just in case.
It's fun.
This is high tech.
Oh yeah, absolutely.
Yeah.
I mean,
Right.
close as it's going to get to high tech.
All right. Welcome back, everybody, to another episode of the Tom Storey Show. I appreciate you being here, joining us on your Sunday or whichever day of the week you are listening. If you're watching us on YouTube, make sure to like this video if you learned anything new today and subscribe to the channel if you have not already. This episode is brought to you by our channel sponsor, Realty Ninja. If you're in the real estate industry and do not have an amazing website that you are proud of, I would highly recommend checking out realtyninja.com/Tom. There's more on them later in the episode. Steve's been using them for over a decade, and I will continue to say this. He is the cheapest person I know. If he's willing to pay for their services, they're probably
Not cheap.
pretty good.
I look for value, and Realty Ninja delivers.
If you're listening on the audio platforms and you have not already left us a review on Apple Podcasts, we'd appreciate if you did that. On to today's guest, Chris Slightham has joined the show. Chris is the president of LePage Signature, is the company that I have worked at for the last 9 years now. Wild. It's
Crazy.
been 9 years. 9 years of my career. I'm really excited to have you here. You're a wealth of knowledge. You educate real estate agents, and it helps them educate their clients on the market twice a week. Yep. So in terms of up to date, what is going on, I feel like you're on the pulse as much as anybody else. So thank you for joining the show, Chris.
Oh, happy to be here. Thanks for having me.
Yeah. So, I just wanted this to be an open discussion about everything that's going on. You've been in the real estate. Maybe let's actually go back to the beginning. So, this company, LePage Signature, used to be called something else, and it goes back generations. Why don't we start there?
Yeah, sure. It's a family business that my grandfather and my father started back in 1965, and here we are today. We've seen a lot over that 57-ish years or so, and it's been a great experience for us. It's a fabulous industry. We love helping people with their real estate needs, and over the years, we've just focused on education, and we pay a lot of attention to the numbers, and we pay a lot of attention to try and help people make great decisions about their real estate, and it's a lot of fun.
So the only thing that hasn't happened in that time period, other than once, is the Leafs have only won the Stanley Cup one time.
Exactly.
Since this company was opened.
I don't think it's our fault.
There's been quite a few real estate bumps along
Yeah.
the road, but only one Stanley Cup.
Yeah, exactly. No correlation
in
with us.
Toronto.
Yeah.
So with everything going on, with interest rates, with inventory rising, pretty much in most markets across Canada, I think a lot of people that watch this show are people that are thinking of buying and selling, right? They're trying to figure out what to do. What's your outlook on where things are now, where we're going? Are we going into a little bit of a bumpy ride here, maybe?
Well, it's a great question. I think that's on the top of everybody's minds when I talk to a lot of our team. That's probably the number one question: where are things going? And I think we can look at the data that we see, and we can have a general sense in the short term of where things are going. But in the long term, real estate's great. I think it's tough to tell with any great accuracy what's going to happen in the next few months or year even. But we do know by looking back over time, when we know with some of the factors that are going on in our markets across the country, that we're growing. Our population is growing. Our need, just a pure need for housing, is going to continue to exist. So as we know, our country's strategy right now, I guess you could say, is to welcome over 1 million people a year. And when every single one of those folks that are going to be coming to our country needs somewhere to live. And the bottom line is that is a good news story for real estate. Our country is working hard to try and produce enough housing for folks that are coming here and for the folks that are already here. And that is an issue that's being tackled right now at all levels of government. So we know when all levels of government are talking about it, there is a supply challenge to support the needs. So that's a factor that we look at. In the short term, we've gone through, we know why we are where we are. So I don't know if we want to step back a few months, 18, 24, 36, 48 months before COVID, the market was bubbling along, global pandemic, first time in 100 years, no playbook for how to manage that. But the banks around the world decided that we needed to loosen up the purse strings, so to speak, and create an environment where money was a little more readily available. And so one of the strategies is, or what happens when they do that is interest rates drop.
Yeah.
And low interest rates, the cost of ownership is a key factor in housing.
So we're finding out right now.
Yeah, right. Yeah. Right. And so with that, we had ultra low rates, an era of, or a few years really of ultra low rates. And I guess, hindsight's 2020. It's easy to say, well, gosh, they left the rates too low for too long. It created more inflation than was necessary. Hindsight is, 2020. We're like, oh yeah, great. Like, if they realized that was happening, I'm sure they weren't going to keep the rates, low for that long. So, but that obviously, now we know it attributed to a faster than normal increase in values in real estate. And when that happens, there's we talk about sort of that curve that shoots up, and the other side of that curve can be a little bit rocky, and that's kind of where we are right now.
Because I feel like if you asked most people and said, if we could just go back to 2019 and wipe out what just happened, would you be okay with it? And other than a few sellers that hit the jackpot in February 22, those people, 99% of people would be like, yes, because we went up and down and it's kind of gone like this. But right now, for the average cost across Canada to buy a house, plus where the current interest rates are at today, real estate is, I would believe, to be the most expensive it has ever been on the ownership of that property on a monthly basis. And I just feel like everyone's kind of gotten screwed in their own way in the past 4 years. Who's ahead here?
That's a great question. I think, I can speak specifically in our market. If you bought prior to, we'll call it summer of 21, and after summer of 2022, you have likely made money in real estate.
In Toronto real estate.
In our GTA real estate. So everybody prior to that moment in time, where that sort of last rush of, very loose monetary policy, low interest rates. There was lots of conversation with the Bank of Canada saying, rates are going to stay low for longer at that point in time. If we can remind ourselves of what it looked like in late 2021, they were talking about 2024 as the first time that they were going to raise rates. Like that's, and then all of a sudden they reverse course. And not only do they change their plan, they realize, oh gosh, maybe we have more inflation here than we thought we had. And not only did they raise rates, they raised them the fastest amount in the shortest period of time in the history of rate setting. So Canada started setting rates in 1935. So it's not like they don't have experience.
Right.
They've been doing it a while, but nobody has had experience with a pandemic. And so
because TIF takes a lot of flack for that comment. Basically, guys, listen, you're good. Go do your thing, borrow some money. You'll be okay. And then snap of the finger, everything changes. I wish that we could go back when we make YouTube videos talking about the market, and then 4 months later someone goes back and comments on it. Well, everyone else, including our company, LePage, gets to put out revised reports. The projections from CREA, LePage, everybody keep being revised as the year unfolds. It's like, well, okay. Revise
with
all my
new
videos.
Information, right? Like
of course.
When that quote that I take advantage of on my channel weekly of Tiff Macklem saying that, The idea was at earliest now, Q3, 4, let's call it, of 2023 was going to be our first maybe quarter point or half point at that time. And that makes me really, I don't know if I should be optimistic or if I should be terrified or what, but what is it that now they say long or higher for longer? That could be just as wrong. Maybe even more wrong. It could be higher than here for longer, and it could be return to normal, which is probably what they should say. Because I think the overnight rate at 4.5 historically is correct, the right number. And they could be putting us in a situation where they got to go right back down to 2% in the next 2 years.
That's a tough balance. You make a great point. I mean, this is, if they keep it now too high for too long and it crushes the economy, then they have to loosen policy. So I think what they're trying to do now, and I look, this is not easy. I don't wish this upon anybody to try and figure this one out.
And didn't Tiff take the job in like March 2020? Like he started
the day before.
Exactly. Day before that.
I've been noticing that on the news. They're like, former governor of the Bank of Canada. I'm like, how many of these guys are there?
Yeah.
They seem to get the boot quite, like Tiff is hanging around. They seem to get the boot every 2 or 3 years, it feels like.
Well, it's tough. And so, to your point, I think so back to, where are things going? I think in the short term, housing is directly correlated to the cost of borrowing, right? So if rates are going to be higher for longer, I think you can expect kind of to bounce around at this level, right? The need for housing hasn't changed. So I think that's one thing we have to agree upon.
I think it's changing, but it's changing not for the better, not for the more available.
Yes. Yeah.
Right.
Good point. Yeah. The need for housing, like there's a high demand for housing, right?
And only getting more in high demand.
Correct. So that's key, right? If you don't have any need for it, that's a bigger issue.
Yeah.
Right. We went through the 90s, and there was a moment in the 90s where, because of the structure of the market, builders could build without pre-sales. So today you can't build a condo or as an example anyway, high rise in Toronto, without 75, 80% units sold with firm deposits in place. You won't get your construction financing. The reason why that exists today is because of what happened in the late 80s and early 90s. Banks were lending because, real estate always goes up, right? I mean,
Of course.
come on.
We get told that in the comments every week, actually.
Every
There's
single
one
week.
commenter that just literally those words.
Every single week.
That's awesome. Well,
I think it's sarcastic, but
yeah, absolutely. So they've learned. So there's and this is what I think is important to acknowledge too, is as we learn, as we go through time and experiences, the Bank of Canada, the regulators, the lenders, they make adjustments, and so that makes our environment healthier and healthier over time. Like for us back in 2018, after a period of there were low rates there. In that time period as well, and they brought in the mortgage stress test. So they needed to ensure that if you were borrowing money at, let's say, 3% at the time or 3.5%, that if rates rose, you would be able to withstand that, because even at that moment in time, in 2017 and 18, the regulators had enough forethought to say, rates may not stay this low forever. Let's add in a little bit of, insurance or confirmation that, hey, if you're going to borrow $500,000 at 3%, and the next time you go to renew, it's at 5%, you're okay. You're going to be fine. And so that was a great.
a lot of people weren't in favor of it when it came out. The stress test, or like the blanket stress tests were applied to everything, because that was January 1st, 2018.
That's right.
I remember that was the first time I ever did live news.
Awesome.
About the stress tests on New Year's Day, because probably they called 5 other people that were hungover, and they're like,
Well, it was already in earlier though on
a different
CMHC
type,
finance properties, and then
But
it came in and affected the whole market.
everything on January 1st, 2018. Then it was a blanket stress test on whatever type of mortgage or what you're putting down.
So now with the stress test, I actually think it was a great thing.
Well, it's looking like a great thing now.
It looks like it's helped a lot of people, which is fantastic, because prices would have gone, if you could have actually qualified at one point 4.9 instead of 4.75%.
Oh my God,
Can you imagine where price would have been? They would have hit $3 million, no problem. Instead of, you know, where they were at up to as high in my market as 1.8, they would have gone way higher than that.
Yeah.
But now that we are at what are probably more realistic historic norms of interest rates, what do you think that should stay? Do you think it should be revised? Because the mortgage broker that I deal with most often is like, why are we stress testing people now at 9% when the likelihood of them staying at 9% for 5 years is almost zero?
And it's a great question. And I think we have to allow a little more time to pass to really determine, are we going to stay at this rate level and for how long? So if this is the new normal, then maybe there's an ability to adjust the stress test. That being said, if you believe that we're at a higher than sustainable number today, we are likely, that means, you know, in the future, whether you believe it's 3, 6, 9, 12, 24 months from now, rates will be lower. Then do we just leave it in and it just maintains itself? I think there's probably a case for maybe a sliding scale of a little bit of a buffer there, because I don't think it hurts to look. I mean, hey, we like to spend, right, as a society. Right? We are not bad at spending, not so good at saving. So, well, if we put in a couple of little, you know, buffers there for everybody to try and help us all out, then I don't think it's a bad thing. But, you know, to your point, could it use a little bit of a sliding scale maybe at the higher end of the range? I mean, the regulator just came out and said that they won't be making an adjustment.
Yeah,
I saw that. Yeah. That was interesting.
I think there's an opportunity there to maybe reevaluate, to go, do we need to be 2% above anymore?
But don't you think that same conversation could have been had when we were at 2% rates? And people are like, well, 5.2 is way too high. Maybe it could be one point higher, right?
Well, if things get
that's what I'm saying. If there's
really
a world
bad,
where we hit double digits, which I would be very, very bad.
But let's say, for instance, we do stick around a mortgage rate being at 7 and 8%, right? 5-year fixed, 7-8%.
It's what the States is
at some point for 30 years.
Well, yeah,
Different
you
thing.
can get out of it.
Yeah.
Okay.
Well, talk about banking regulators not doing things right for people, right? 5-year fixed rates. Anyway, if you get to that spot and housing becomes a real problem in not moving the economy forward, which it also needs to do, then I could see them going, okay, well, maybe if we were 7 years stays here for 2 or 3 years, those rates, maybe we can start backing this off. Maybe it only has to be 1 point above. Maybe it doesn't have to be 1 point. Maybe it has to be 2 points above or 7%, whichever is lower, right? Instead of whichever is higher, right? So these are different things that we can maybe play with a little bit, because once you get to 7.5%, do I really need to qualify at 9.5? I don't think I do. And it could put us in I think they're going to mess with it at some point in time. That's just not going to stay there. They already messed with it to turn it up, right? At some point in time, they're going to change things.
This episode of the Tom Storey Show is brought to you by Realty Ninja. Hey, real estate agents, I bet you didn't get into the real estate industry to try to become a web developer. Realty Ninja will help you build a beautiful website for your business without becoming all techie, because me and Steve are certainly not techie. They'll set up your entire site for you, they'll migrate the content from your current site, and they'll take care of all the back end, switching the domains, all the things that you don't want to do, they'll take care of for you. Their team of in-house designers will make your new site match your current brand and help you stand out from your competitors. Best of all, Realty Ninja offers a free unlimited trial that lets you build out your website, and they do not charge you until you're ready to launch. That's right, they are so confident in their product and that you're gonna love the website that you build with them. They will not charge you until it's ready to launch. They don't even take your credit card details. Listeners of the Tom Storey Show will not only get an unlimited trial before you launch, but if you go to realtyninja.com/Tom, you will get 20% off your first year after you launch. A beautiful, functional, and professional website is absolutely a must in today's real estate landscape, and Realty Ninja delivers. So go to realtyninja.com/Tom for 20% off your first year. That's realtyninja.com/Tom. And now, back to the podcast.
You think so?
I think so. I think they have. Well, I think they're constantly going to be changing things.
Well, that's what I was just going to say is that the good news is they're constantly analyzing and, again, trying to make the best decisions for the long-term health of the economy and citizens of the country and homeowners. And I think that we have to believe that, look, are they perfect? No, nobody is. But is there effort being put in to try and figure out?
I don't think they're trying to screw us.
But do you think,
yeah, exactly.
Do you think the brass at the Bank of Canada is just sitting there going, look at those immigration numbers. What do we now what? Right? They're just like, guys, like we can't do anything over here anymore.
Yeah.
We got no other tool. We have one tool, interest rates. That's it. We're not doing anything else. We can tell people where we think they're going to be, but that's obviously proved not to be good. You think they're like phoning, like, I don't know if there's an immigration minister or what it is, but like, guys, like, help us out.
Yeah, it's a good point. But
It must be a running joke in their office is what I'm saying. Like when the microphones aren't like, they must be like, did you see this? They're just sitting around swearing about.
But we're lucky here in Canada, I think, as a country to have, to be one of the greatest places in the world to live, and so that we have growth. I think there's without growth, and I don't know what the right numbers are. I'm not an expert in terms of how many can we properly manage on an annual basis in a way that benefits everybody and everybody has a great experience. But I would suggest that we're lucky to be a place that people want to live. And
I still firmly believe that, because there's a lot of people that will comment below this that say Canada's not a cool place to live anymore. And I mean, I don't know what to say about that, because I'm super stoked to be here. Still am,
God,
right? Always am going to be. And they'll blame a certain politician. This person's making it bad or that person. I'm like, if you let one politician change your perspective of your country, that's kind of a sad outlook.
It is. And I think that, we get sometimes, and I get it too. I mean, it's frustrating. I appreciate that it is frustrating that, things could be handled better. A lot of it is hindsight, though, that you look back and go, gosh, maybe we should have lowered rates sooner, or whatever policy, that you're not happy with. But as a whole, you think about our country and you think about the opportunity here, and you think about how lucky we are with all the things we do have. It's a pretty special place, especially if you travel a little bit around the world and see, what different, places, how they operate.
We did that when we were on our trip in Mexico with Richard Robbins. I got to have a really good conversation with him, and he's like, the one thing that Canadians take for granted, and probably Americans as well, is the access to capital to do anything you want to do, whether or not that's buy a home, whether or not that's start a business. There are countries where that's just not a thing.
You can't get a mortgage.
You can't get a mortgage
places,
in Mexico, just period. So you have to save up. Sure, a house might only be $100,000, but if you're making $600 a month, how long is that going to take you to buy? Right? So the opportunities that are here get shrugged off often. And I agree with you completely.
Yeah. I think if we stop focusing on the negative and start looking at the positive.
How do we do that exactly?
It's a great question. We'll do a whole session on that someday, I'm sure.
Being realistically optimistic is my new term.
Yeah, absolutely. And I think that's exactly right. And look, it's not all, sunny days. I get it. I mean, that doesn't exist. But I think taking a positive view and looking, and that's with real estate, like saying earlier, about do we really know what's going to happen in the next 3 to 6 months? Well, it looks like, based on the data, where we can generally see that it's likely going to stay in this range. Like we've got decent transaction volume, lower than historically normal in our markets, but people need houses. Sellers are coming to terms with what their values are with their homes.
It's finally happening that the sellers are acknowledging, oh, okay.
Yeah.
We're here now.
And look, we've talked about this, Tom. Like we review the data, and if you go back and you look at where we are today with our average sale price versus, where it was 5, 10, 15, 20 years ago, we're right on schedule for the normal level of price appreciation. So you made that comment, like if we took that sort of moment in time out of the, like if you could sort of block out your memory of that 12 to 18 month period where prices got a little bit, well, and really in our market, they got way ahead of themselves for a short period of time. And you regraph, just missing that moment in time. Like it's a very, very healthy, where we are today is a very healthy, sustainable.
And that's the 40-year kind of tracking where things are at.
Yeah.
And we're a little bit ahead of schedule still.
We actually are. I mean, if you really,
and that's based on a what per year?
That's the 40 plus year averages in the Toronto Real Estate Board numbers is about 6.8% a year, you know, through all the highs and lows, right? Through the late 80s crazy boom, through the lows of the 90s, through the little peaks and valleys since 2001. It's about 6.8%. And so if you go back to that moment of time, which we've done, and we've just taken a look to see, well, where do we stand today? If you bought in 2018, 2013, you know, 2008, 2003, where do you, and you're actually still a little bit ahead of schedule based on the traditional or the average of that
chart that you guys give us. Can we add that to the show notes of this show?
Oh,
because
yeah,
I think that'd be very interesting for people watching this or listening to go download.
I have no idea how to do that, Tom, but we'll figure it out.
I'll put it into it. We'll figure it out.
The link might be down below in the description.
But it's very, very interesting to look at, okay, the last 40, 45, 50 years of Toronto real estate and how it goes and how through definitely a crash in the late 80s, which took 13 years to get back to that price point. 2002, I think it finally leveled out to the 89 price. Then 2008, where price didn't actually drop, just transactions dropped. 2017, 2022. So we've had crashes, and then three, you could call right now a crash, depending on market, maybe just bigger correction, and then two kind of minor corrections. But through all that, almost 7%. And so, and this, I talk about this on many episodes, but I always think about, we're always talking about today.
Agreed.
About today. Okay, in 10 years from now, I mean, the next 10 years of growth shouldn't be the last 10 years of growth, right? That would be a little bit out of whack.
So I always, and I'm super conservative just by nature, so I always say, well, go at 5% or go at 3%. Do something like whatever.
Nice to see 2 or 3% for 5 years.
Yeah. Could you imagine if the market over the last 40 years just exactly was a nice hover market, and it wasn't like,
but that's, you know, so there's, you know, the great point, and that's not the case. And there, you know, there'll be something else that'll be next that'll cause it to rise maybe a little ahead of schedule, and it'll likely need.
So I broke that down. So where I work, the Fraser Valley outside of Vancouver, I broke that down, and it was 6.6%.
great.
And that was
For 40 years?
Over 43 years of
That's
data.
pretty funny,
Right?
eh?
So
it's almost the same.
So, but I mean, we're talking about GTA and GVRD. So, I mean, the two most well, I don't know if Montreal. We've never had someone on from Montreal. We should probably find out what's going on there. But when you broke that down, so that was the average. But more often than not, it was actually like 9 and 10% growth of the years that had growth.
Yes.
Right. And then you saw like 7 and 8 and 9% deflation in a single year as well. And then there was something like, of the years that had growth, a third of them were like 15% or higher. Right. So you get these crazy swings when you actually break down year after year after year. And that's why Tom and I are just so hard on, like, don't buy something if you're not going to be in it for 5 years.
Absolutely.
Right. If you're going to day trade this stuff, just avoid it. But no one in our comment section of this show thinks more than 18 months out max. Right. And if they do, they say 2040 houses are going to be worth 4 cents. Right. Like, that's what the type of reaction you get. And then I did a video of which I get roasted for on my channel now quite regularly.
Steve gets roasted a lot.
Of where I said, listen, just the current growth that we've seen historically over however many years, 43 years, in another 20 years, the average house is going to be $3.6 million. Everybody's like, never, never, never. I'm like, they also said never, never at $100,000.
Right.
They never said it's never going to get to 200.
No.
Ever. And our taxation in BC is actually based off of it's never going to get to 200 because they brought in the luxury 2% transfer tax at $200,000.
Oh, yeah, we've got a new luxury tax here in Toronto.
Yeah.
I looked at that. That is ridiculous. They want all the money.
They want all the money.
But
Steve, it's just the rich.
It's just
Don't
the
worry.
rich until the average house is $4 million, and then everybody's paying 5% to the government every time they want to move.
Yeah.
Right? Extra commission.
The government commission.
The
third commission is what Steve calls it. Yeah.
It's well, look, it's again, regulations are and ideas are formed as we progress, and so maybe in the future it does change. But I think look, it's a challenging reality that housing gets more expensive over time. But it's something like Warren Buffett always said, when he's asked, well, what do you think the stock market's going to do this year? And he said, well, I couldn't tell you. I couldn't tell you what's going to do this year, but I will tell you that if you buy a company or an asset that you really like and you hold it for an extended period of time, you're going to do really well. And that's been his. So if you're talking about the stock market or gold or and I don't know really anything but real estate.
Steve, you stacking up gold these days?
I'm not.
Okay.
But I would say that if you believe in real estate and if you believe in the growth of our country, of our part of the world, then real estate's going to be worth more, in the future. Is it 3% a year? Is it 5%? Is it 7%? Is it some years we're going to have an accidental 15 because of whatever factors are driving it at that moment in time?
Yeah,
we might. We'll be down 7 one year in response to a rapid increase for a couple of years. We might. But if you look at it over 5, 10, 15, 20, 40 years, it's a pretty exciting
This
story.
year has been a demonstration of that. Like when I did kind of like, where do I think things are going to go this year in January? I was like, there's no way they don't decrease at least 5, if not 10% this year. And then they went up 15. I'm like, what the heck is going on?
Well,
and they did it by June, and now they come back
now
off
they've come
another
down,
5.
Yeah. Well, we should actually touch on that for a second. I think, so why did it go up 15? And because I think this is informative for people to kind of at least think about that. So what happened in the first quarter of the year? Two events happened. One, the Bank of Canada in January said, you know what, we're happy with where rates are. We're going to pause for the foreseeable future, they said at that moment in time. The other thing that happened is there was a banking crisis in March, which a lot of people might even listening to this right now might, oh gosh, there was what? Banking crisis?
Right.
Remember that?
There were, right? Remember that?
Yeah.
And so what happened with the banking crisis is it caused the bond market to adjust, which dropped
Fixed rates,
right,
Yeah.
Tom? And they came from, I think in March, let's say they were 5.2 or just over 5%, and by the middle of April they were down at sort of 4.5-ish or 4.7 maybe in that range. So, point being, it wasn't a major swing in rate reduction, but it was enough to drive our values up 15% from January to May. So those two events. Certainty, what we thought was certainty, I should rephrase that.
Right.
What we thought was certainty that we had done our rate increases. So kind of like, okay, well, if this is where rates are going to be, I can start making decisions because that's a normal, reaction. But the other little kicker there was fixed rates came down 50 basis points, 75 basis points for a short period of time, and boom, the market took off. So I share that because I would hope that people keep that in mind as they're planning, because if you're waiting for rates to come down to make a buying decision, you're going to pay more, right? Which is fine. And if you need that confidence or you need that rate, but you're going to often pay more than you're going to save on the rate. There's a perfect example of what just happened.
It's funny that you brought up Silicon Valley Bank and all that stuff, because that was the end of the world for a month. Right? This was like Lehman Brothers. Here we go.
Yep, you go.
And then, wait, I forgot about that. 4 months later, 5 months later.
But at that time, you could get a fixed rate for 4.5. And as I know very well, right now, it's 6.5 or 6 point. If you take the 5 years, like 6.2 or something. It's a big difference. It's a big difference. Everyone else is focused on Bank of Canada, what they're going to do. Like I think sometimes we forget, like, the general population of people living in their homes might not understand that the fixed rate is different than what the Bank of Canada does, and how they don't, right? Why would they really? Until it comes time to really understand it. Yeah. But I mean, and right now, okay, the rates are certainly higher. The actual rate that people are getting is higher. But the one thing we have now that we didn't have in the first 5 months of the year is inventory. We have inventory finally starting to build up, which we've kind of been asking for and saying like this would be a good thing.
It is a good thing.
And now, we had Andrew Russell on the show from Red Deer, and we were telling him that Toronto inventory was like 4.5 months, and he was laughing at us. He's like, "You guys, you have no idea. Like you're complaining about 4.5 months of inventory. Like I would have loved that.
Yeah.
So it's all kind of perspective, but." One thing I wanted to figure out, because no one thought, well, at least I didn't think, and Steve didn't think, that 2023 was going to start the way that it did. Those were external factors that made that potentially happen that we didn't know were going to happen. Now, typically, and when I'm looking at the listings right now on the market, there are a lot of listings that are past 30 days on the market. There are many. Now, those sellers are going to have to, at some point, come to the conclusion, I am priced wrong. I need to change my price. I become a rental. Or I take it off the market.
Yeah.
December 15th seems to be the day that we go as real estate agents and, you know what, take it off. We'll give this a shot next year when the market picks up again. Let's wait till spring next year. Now, we are now fundamentally in a balanced out market across the GTA. We're in a buyer's market for condos and other specific pockets. Do you think December 15th half the inventory falls off? Because it's not impossible.
No, it's not impossible. And I think like there's inventory and there's saleable inventory.
That's yes.
Right. And so that number at 4.5 months, which is I think is great. I mean, to your point, Tom, I think, we've been hoping that there's be a little bit of inventory, a little bit of choice for buyers out there. It does affect pricing pressures one way or the other. Whether when you've got low inventory, prices, tend to get pushed up. Higher inventory, it either stabilizes or inventory gets too high, then that'll be an indicator that prices come down, and we watch that very closely. But it's a great point. If people, I think what is going to happen here is people will make one of those three decisions.
Yeah.
Because I think it's important to know that, your real estate hasn't gone bad. Right? It's not like, my house isn't worth as much as it used to. What's wrong with my house? It's not like, I got a leaky roof now. My house is worth $100,000 less. That's not the reality. The reality is you've got great real estate. Real estate in our country is a great asset. What has happened is the cost of owning it has changed. That's all that's really changed here. As I said earlier, the demand hasn't disappeared. We're bringing in 1 million people a year or we're welcoming 1 million people a year into our country so that they need housing. So the demand hasn't disappeared. We haven't increased supply at all.
No, in fact, it's gone backwards
in the last 6-7 months.
It's so expensive to bring it to the market.
Exactly. There's been 75% fewer new home sales in the Toronto area of condos versus the previous 9 months. So that's declining. So that's future inventory is being taken out of the market. So that's not the case. The factor is that it rapidly became more expensive to borrow money in a short period of time, which if you look at, we did an amortization chart. I mean, I think I don't know if you've shared it with your listeners, but I know you've done it as well, is what has happened to my purchasing power in this time period. And that's what's happened. The purchasing power has declined. It's that simple. So if you don't have to sell and you believe that either rates are going to get a little lower in the future and demand will also assist in pushing prices higher, you just keep the asset for longer and they're going to do just fine.
I think some buyers believe, and this is where it gets interesting, because there's the decrease of pricing from the peak of the market and there's the increase of the rates, and the prices have not increased as much as the rates have gone up. That's why it's more expensive than ever. And some people look at it from kind of the outside and go, okay, if that house was $1 million at a 2.5% rate, well, now at a 6.5% rate, that house is worth $750 because the payment to own that house. And on a logical way of looking at it, I would understand that, but the market or the sellers do not think that, right? No. That's not happening. And because not everybody that is buying that next house is getting a fresh mortgage at that rate. They're taking equity from the other one and pulling it over. And we're all nodding our heads, but I think maybe some people don't think of it that way. It's just this is what it's worth now. Right? Like we're getting a lot of calls from people without realtors on our condo listings, basically being like, will you take $100,000 under asking? We're like, oh, we're not there yet. Yeah, we appreciate the call, and I understand you asking. It's okay, but no, and some of them are baffled. They're like, "Are you serious? Like, you should take it." I'm like, Not yet.
No,
But maybe.
Maybe we should.
Maybe.
maybe some sellers will, at some point in time. But I don't, I agree with you, Tom. I think that the demand exists. The need for housing exists. We're just trying to determine value based on what people can afford today. And I guess the jury may be out a little bit here for, till we get through to a more clear view of where rates are going to settle in.
From what you just said, though, you are getting calls in from the buyers, not from the buyer's agent, saying, will you take this much money? So likely they either aren't educated by working with somebody, or they didn't like the answers that they got from their agent about where the market realistically is. So they're phoning you directly to try and get reinforced of, where they want the market to be. They want to just buy at this lower price. And probably the seller, the buyer's agent, and the listing agent are all like, hey, that's not where market is. But they have this hope that that's where it's going to be. They have this hope that maybe in 6 months, it could even be there in 6 months, but it's not there now.
Yeah.
And they have this hope of maybe I can pay 6 months from now projected decreases today.
Well, if that decrease were to happen on that property from 650 to 550, something bad would have had to happen. Interest rates would have to go up more, and it would probably cost them similar amounts per month to own that property.
Per month, it's not going to change. Per month, it's only
or it's going to
actually
go
gonna
up, maybe, right?
Yeah, which is the silly thing. I've been screaming that.
But so for that example, someone listening to that might go like, "Oh, well, that's just real estate agents keeping prices high still, right?" Well,
that's what we do, propping up the market,
right? Yeah. But most of my conversations on a daily basis with my sellers is actually, here's what's going on. We should have a conversation about adjusting our strategy soon if we want to be in the percentage of listings that are actually selling. Like most of my day is actually convincing sellers with data to back it up that we aren't priced correctly and you need to come down in price. Because
if you want to sell.
Exactly. Yes.
Right.
If you want to be in the percentage of properties that are going to find a buyer this month, here's what I would recommend based on what the numbers are telling us. Yeah. Most of my day is actually doing the opposite.
Yeah.
Not that I'm trying to bring prices down, but I'm trying to show people realistic outcomes for their properties. And it's just funny that you never win. And I made a video a few weeks ago where I was talking about the transition zone, right? Like I think we're at the 4th month of the 4-month transition zones where sellers are now clicking in. And one of the comments was like, realtors always have a way of figuring out every market and making it good. I'm like, well, what am I supposed to do? Like sit here with my twiddling my thumbs? Like I'm going to show you the information you need to make sure that you have, but you can't win on any direction. And it's funny because I feel like me and Steve have a different perspective because a lot of our industry just talks to our industry. Where like we talk to lots of people. Well, not directly sometimes, but it's interesting.
But what they don't understand is your job is not to pump the market. Your job is not to do the quick sale. Your job is to
that'd be a dumb business model.
Facilitate a transaction. Yeah. Right? That's really what you do. Yeah. And so when you're facilitating a transaction, you usually have to educate your own client on where market value is most likely. And market value is usually most likely more than the buyer wants to pay and less than the seller wants to sell for. Right? And that's what you're trying to do. You're trying to find that market value. And so your client will naturally always think that you're working against them because they don't want to pay market value. Like you've never been able to bring a property to your client and go, hey, you know this thing that looked good at $550, I got it for you for $450. It's never going to happen because you're exposed to the market. Right? Unless you wholesale, which we talked about last week, which we probably shouldn't get into again. But I mean,
we do not agree.
We do not think wholesaling is a good idea. If you want to call it that. But that's why you're in that situation constantly, is because you're trying to facilitate the transaction, no matter if the market's up, no matter if the market's down. That's why I think that, this whole thing of, realtors are going to be quitting and working at McDonald's soon is funny because
some will.
For sure. But those guys were probably already working at McDonald's. But there is, when those prices come down, you still need someone to facilitate the transaction, right? Like when those purchase prices come down, there's always somebody there. And you can get as mad at you as you want at the Bank of Canada or the big banks for stealing your money or the real estate agents or me getting mad at the government for taking their piece of the pie, but the transactions are going to happen. And we just have to be there to facilitate it and give the clients the best advice in that moment. And
Well,
it has to be in that moment.
Well, it can only be in that moment.
Exactly.
What else are you going to do?
Yeah.
Right. And right now, the question, I'm sure you're getting this from everyone you're talking to, Chris, is like, well, if we're not going to get our price now, well, how long do we have to wait to get our price?
And that's
great
the crystal
question.
ball
Great
question, right? That's a brilliant, and that's exactly it. And that's the crystal ball piece that nobody really knows per se. I think all what you have to assess is where and how do you think rates are going to behave, and that's going to guide you as to where and when that price would surface for you. So if the government, if the Bank of Canada and the government wants to keep prices stable, which means they're trying to eliminate inflation, that means they're trying to keep things flat, let's say, for at the very least, certainly not going up. So it will take you longer to get back to if you say, look, I want that February 2022 price. That's the number. That's my number. Okay.
That could be 10 years from now.
Could be.
Well, it could be.
I'm not saying it will. I'm just saying.
Yeah, but it could be. Right. Sure. Yeah. Let's
Like
say
if
that.
that's
Yeah,
the
right.
1989 example,
Yeah,
it
that's
could
right.
it could be 13 years from now.
It could be. You're right. It could be.
Probably somewhere in the middle.
But
But
it's probably somewhere in the middle. Yeah. But you're right. But it could be. Absolutely. So I think, putting into context though, where have you come from with your real estate? So if you've owned your real estate for 5 or 10 or 15 or 20 years, you're really right where you should be, right? Based on that analysis we talked about earlier. So it's never easy to say, well, my neighbor got 200 grand more than I did. I mean, God, but for whatever reason, you weren't a seller at that moment in time. If today you are a seller, then let's look at the history of the ownership of your property and where you've come from and the results that you've generated out of that time of home ownership. And if you can wait longer and that's your number, then great. You have a beautiful home. Enjoy it as you've enjoyed it for years. Have holiday parties and birthdays and all those great things, and enjoy the backyard and shovel the driveway this winter and enjoy every minute of it, because it's great real estate. It'll be that number, whatever that number you need, some in your mind someday.
and making sure that they understand that the neighbor that got 200 grand more, the buyer that bought that house, at least for the first 5 years of ownership, their monthly payments still going to be less than if they bought your house 200 grand less. Like, so that's really
I
at the
had
end of
that
the day.
thought the other day because I had somebody who bought like the week of the peak of the market for like a crazy price. And immediately I want to say 20% of that eroded in 6 months. Right? Like it was like, holy crap. And I don't feel great about that.
No.
Right? Because we're going through that and, having conversations. I know. And then maybe it's my stupid realtor mind that has to justify everything, which all of our minds do. I was like, well, wait a minute. They bought like a townhouse 2 years ago for, let's call it 400 grand. And they sold it for like 900 2 years later. I mean, what part of that is actually eroding? Right? Because they got a crazy lift. I mean, they bought that next house with, let's say, 50% down or whatever. That 20% they just lost came out of the townhouse. And when they bought that townhouse, they put down like $20,000. So you're all just sitting there floating on the market, unless there's some magic day when you can cash out and live for free.
And it is, I guess, a loss in the sense that the value, if you had to sell today, you would sell it for 20%,
A lower sale
number.
price.
But on the other hand, if you're going to live, if that's their forever home, or that home that they're going to be in for a long time, there is no loss yet, right? Because when they choose to sell and they've lived in it for a decade or 2 decades maybe, what is it going to be at that moment in time? So it's a little painful in moments in that journey. I get it, and I respect that 1,000%. But ultimately, at the end of the day, they're going to have they've got a beautiful home, and when they're ready to
So
sell
it was
it,
a beautiful home. I phoned them because I was like, oh, this isn't going to be an easy conversation. But the value never came up in the conversation. I was like, hey guys, how do you like it? They're like, we can't believe how awesome this place is. It's so fantastic. I'm like, oh, okay. So, like, what are the plans? What's going on? Are you doing any renovations? Oh, we're pregnant. And it's like, oh, So they haven't even thought about that. They're so stoked that they have this home that they can live in for 20 years and now start a family. And I'm like, oh, that's probably what most people that actually buy and sell real estate focus on. And they're not focused on, they're only at that moment, right? Just like interest rate. They're only focused on that interest rate at the moment that they're signing the mortgage. And then you phone people 6 months later, what's your interest rate? Look at me. I'm the dummy that didn't know when my mortgage came out.
Do you need insurance? The answer to that question is obviously yes, of course you do. Whether you are a tenant, landlord, or homeowner, you need to insure your property and belongings. And when I insure my investment property, personally, I choose Square One. Square One is affordable online insurance for everyone. If you apply for your Square One insurance policy using the link in the description of the show notes, listeners of The Tom Storey Show can receive $20 off right now, simply by going to squareone.ca/The Tom Storey Show. Square One is no joke. I personally use Square One for my landlord policy on my investment condo. I picked Square One because they were easier to work with than other insurance companies. And when I had an issue with my previous policy coverage in relation to my Strata's coverage, Square One was the insurance company that came up with a solution for my insurance problem at an affordable rate. Online quotes take less than 5 minutes with Square One. Get your home insurance quote today at squareone.ca/The Tom Storey Show and save $20.
Tell Chris what happened.
So I had a
horseshoe stuck up his.
when the pandemic hit, all my clients were getting great interest rates, and I was like, well, I want a great interest rate. So I phoned my bank and I said, what can you do for me? I don't want to defer, because remember, you could defer. I said, I don't want to do that, but just don't give me this crap rate that I have, this crazy high rate of 3.59%. I was like, I don't want this anymore. And I was like, all my clients are getting like 2.29 right now. And they're like, well, we can't do that, but what we can do is bump you down to 2.75. I'm like, okay, I'll take it. I'm great. What I am too stupid to realize is they did a blend and extend. So I thought my interest rate was up this last March. I still got 2 more years on it. Right. So
Fantastic.
yeah, you just walk backwards into it. But I couldn't even remember that I did that blend and extend.
Yeah.
And I also thought it was 2.79 and it was 2.75. So people only pay attention to that in the moment of what they're doing it, just like their sale price of their home.
Right.
What'd you pay for it back then? I don't know, 200 and something, maybe.
Yeah.
And that's the reality of most people that actually end up buying and owning real estate. Is they get on with their lives.
Well, I mean, I think you're buying your budget, right? Is what you're doing at the time.
Your monthly payment.
Your monthly payment.
Yeah.
That's what you're really buying. And you're saying, well, I can afford, my family or myself, I can afford X.
Yeah.
So, they call up, Tom or Steve or whatever, they call you guys and they say, okay, well, this is what my budget is. And they're like, all right, well, let's go. What can I get for X number of dollars? And, in this, I would like to live in this area or that area, or maybe I'm not even really sure where I want to live. So to help me figure that out. But that's what you're generally buying, is your budget at that moment in time, and hope, and that, relative to, of course, what your needs are, but that's what's driving the decision.
And right now we're qualifying more, or we're buying on needs rather than wants.
Absolutely.
I would say more than ever before, because that's what I think housing affordability really is getting affordable housing is getting your wants. Right. And unaffordability is scraping into your needs, which I think is where we're at right now. Right.
That's a good point.
Chris, we've gone out for lunch multiple times, and you always pull out a piece of blank paper and you show me a chart, and it changed my mindset on how I'm thinking really, really long term about myself and my investments in real estate. And I was just wondering if you could break that down, not to a real estate agent, but just to somebody listening to this that maybe owns their principal residence and is thinking of investing in the market, but there's lots of chatter out there that don't do it now, wait, but we're talking 30, 40 years from today. So just what is that thought process?
Yeah, it's a great question. I think we've touched on it a little bit today already, and the fact that owning real estate over time is really
hard to argue that.
It's hard to argue.
Yeah.
Right. So the way we've always looked at it is, if you're looking to invest in residential real estate, is what we like to, invest in. It's easy. People need housing. They don't always need office space, or they don't always need a retail, store or for businesses, but people need housing. So the way we look at it is that if you buy an investment property today, or you buy a home today, and even if it doesn't go up in value over time, you're generally buying it with a mortgage. And so if it's your own mortgage, you pay it down over time. So we'll call it a forced savings plan. You know, back to the fact that we're not great savers, but there it's forcing you to save. And every payment, from the very first payment, you're actually depositing in your account.
Right.
A portion of that payment. When rates are really low, it's a pretty significant number. It's a little less today on your first payment, but that's what happens. When you buy an investment property and you pay that first mortgage payment, or your tenant pays it for you, all of a sudden you are putting that deposit in your equity account. And if you look at that and you chart it over time, you'll see that the returns you get from that are massive. And really that's what the whole essence of investing in real estate is about, is you get healthy leverage, like healthy debt, first mortgage debt, because you can fix the term. You get the benefit of time. You have if it's a tenant, you have the tenant is paying that mortgage down for you. And then let's imply some level of growth, right? Whether we know that the average is 6.8% in our marketplace, but imply, as I said, or be conservative, imply 3% or 5%. Right. And if you look at that and I do it generally over a 20-year time horizon, the results will, I think, Steve, to your point, it's like, it's hard to imagine that prices are going to be $3.6 million in 20 years from now, or 40 years from now, whatever the timeline was that you did. And so sometimes it's hard to fully appreciate, but once you look at history and you look at and imply whatever number that you are comfortable with, it's an exciting result. And so again, it's not timing the market, it's time in the market, and it's, patience. And that's really how we've always viewed it. I would encourage anybody who's considering to educate themselves about what that looks like. I mean, both you guys are brilliant at numbers and study it. So anybody could reach out to any of you guys and say, hey, can you, draw that chart for me? Yeah. And I know you guys would be happy to do that. And that's what makes me passionate about it, right? That's really what makes me excited about real estate. I mean, of course, we're of course you guys are happy, you're excited about it. It's your business. It's your real estate agents. I mean, that's what you do. You have to be happy about it. Well, if you do take a step back, and I'm not suggesting it's the right time for everybody to buy real estate right now, and maybe it isn't the right time for you to buy real estate, but it's always the right time to be educated about it so that you can make the right decision. And I think I would encourage everybody to view real estate over a longer time frame, to think about what's happening. So on day one, my mortgage is, I don't know, pick whatever is relevant to your marketplace. $500,000, right? And what we've looked at over the years is that even if on day one you buy an investment property and there's a small shortfall you have to feed it a little bit every month at the start because the income doesn't match up with the expenses right away. By year 20, if you're diligent and you don't need to spend any of that income along the way, you can get that property paid for. Some people might be, 20 years, oh my God, that's a long time. Mm-hmm. Well, look at that return, and also look and at those numbers and imply a little bit of, just imply 3% growth.
But growth isn't even what you're most looking at here.
Correct.
It's paying off the mortgage and the money coming out.
Right. So let's say in 20 years, you've paid off a $500,000 mortgage, right? And so now you've saved, let's say the house goes up zero.
Sure.
It's worth X today, and it's worth 600 today, and it's worth 600 then, and we had a $500,000 mortgage, and now we have $600,000 in our savings of equity in that property, and we still have a tenant in there. Now the money's not going to a mortgage; it's going to you, the investor, for eternity, right? Like for the rest of the ownership of that property.
And I'm trying to tell even just end homeowners to get there, or if you're just getting your principal residence, because once you retire, and maybe you have a pension, most people don't now, and you get a CPP, good luck paying your rent with CPP right now. It's not even going to cover. Like if two renters are at home now and they both have full CPP, what is it, $1,200 a month or something like that?
I'm not sure exactly.
$2,400 a month. What does that get you? And do you want to eat this month? Right? Doesn't happen. So just to get to that spot where I want to be owning my own residence free and clear 25, 30 years from now is what I think the goal for everyone should be.
Absolutely, because you've and then you imply a little bit of whatever number you want conservatively growth in that value, and boy does it really knock your socks off. Right?
And the rent goes up a little bit over 20 years, doesn't it?
I mean, right now, even if it's I mean, it's going to go up 2, 3, 4% a year, 5% maybe in some years. You're going to have, so that's the cool thing is it's generally indexed to inflation, right? So $1 is worth $1 today as it is in 20 years from now when you're talking about rents as well. There's all these little nuances of investing in residential real estate that really, once you get into it and you start to appreciate these little nuances, it's not super glamorous. Like it's not fancy. Like we didn't buy, Apple at $9 a share in 1997 or whatever, and right, but it's slow and steady, and the results are absolutely incredible.
But even that example you just gave, if I bought Apple in 1997, right? This wasn't if I bought Apple last year.
No,
right? It is a long-term.
It's long-term
Right. Game.
And then the thought to it is, okay, right now, whoever's listening to this, whatever age they are, plus 20 years from now, whether that is a retirement age, a not retirement age, anything, just how much money is coming in. And the conversation that you had brought to me was like, well, what do you need to retire? What would it cost you to live on a monthly basis? And probably whatever the number is actually more than that, right?
Yeah.
So how many of those properties, because the thing that I always got stuck on was like, well, if these things are paying off, my net worth is just going up, that helps me sleep at night, and I can just sell 3 of them when I'm older and cash out. And yeah, sure, maybe at that point, if it's a lot of money in today's environment, you could put it into a GIC and be pretty happy with it.
Yeah.
But your whole thing is like, never sell. Who cares that it's paid off? Not that who cares, but like that's just what's going to happen naturally. The rent prices are what the rent prices are, and let's say property A. These are above your principal residence, right? Property A is bringing in $3,200 a month cash flow.
Yeah.
Property B is bringing in $2,800 a month, and you keep going and you add them up. You go like, well, if I need $15,000 a month for my retirement or whatever that number is, how many of these do I need, and how long is this going to take? And it's a long-term, potentially boring solution that will put you in an amazing position.
Yeah.
But you got to start somewhere, I guess.
You do. And look, get one.
Yeah.
Start with one. And I think and it's not without sacrifice, and it's not without hard work, and without, and it's not easy. But you do, if you're able to figure out a way to either use equity in existing property in a safe manner, and I say that very carefully, in a very safe manner, to take a bit of equity out of a principal residence safely, which means low leverage. Don't put yourself out there. Or, if you're in a position where your household can build up some savings over a period of time and find that first investment property, you won't regret it. And it's tough. And I'm not saying you've got to run out and buy something tomorrow. There are opportunities out there right now for certain. If you've got capital available to make some good investment decisions, when would you rather be buying? February of 2022 or November of 2023? Right? I mean, that's...
So the objection right now for a lot of people is, I want to wait and see. And that's always an objection.
Of course.
Right? Going to wait and see. So if you're thinking about that and somebody listening to you right now is like, you know what, I do want to start my 20-year, 30-year plan, but I want to wait and see. What is the wait? My
Is it going to matter in 20 years?
My response is always, I appreciate wait and see. That's a fear statement. It's just saying I'm unsure of right now, which we're always unsure of right now. But then I tell them to get a metric, like what is your measure of success? Because you can wait and see forever. So if you're an investor that's looking right now, and I'm going to ask you about your market in Toronto, what would you be looking for? What are you waiting and seeing for if I was trying to become an investor now?
I think some people are, and maybe a lot of people right now are uncertain about what the short-term values are going to look like, right? So I think that's causing people to wait and see. The challenge with waiting and seeing, and we touched on it a little bit on one example of waiting and seeing, when rates do drop, prices pop.
Prices might go up.
Right. So now you've missed that lift. Right? My dad, taught me this when I was young, that the sooner you get into ownership of real estate, the sooner it pays for itself. And that's the challenge of waiting. Now, again, there's a lot of factors for every individual that might be listening, to this and saying, well, how does that relate to me? First of all, you've got to figure it. Yeah, is the timing right for it? It might not be, as I said. But if you're making a decision to wait and see, to your point, what are you waiting for? Make sure it's for the right reasons for you and your scenario. But in our case in Toronto right now, and there's great buying opportunities, that great in the sense for the long term. I can't tell you what they're going to do in the next 6 to 12 months exactly. Oh yeah, here's the chart. Like, right. We're not. It's not something you can. There's no asset class out there that you can chart perfectly. But I will say that based on historical values, where we are today, there are some great opportunities in the market. You're going to get some. If you're out there looking around with somebody who knows the market really well, then you're going to find a great opportunity. And 5 years from now, 10 years from now, when the property's well paid for and prices have started to climb again, you're going to look back and go, whoa. But if you wake up 5 years from now, still waiting, if you do the math on that amortization of what you would have paid off in that time period and imply 1%, 2%, 3%, 5% growth, whatever you want to imply in that time period, the worst thing you could do is wake up 5 years from now and go, oh gosh, I should have, because no time is it going to feel like, oh, this is a guarantee. Like, there's no moment in time that buying real estate, you're taking on debt that I'm aware of, that you're ever going to feel like, oh yeah, this is a walk in the park. Even today, after 60, 70 years of our family investing in real estate, when we go buy an asset today, we're still like, yeah, are we sure? Yeah, are we sure? You still get that feeling, because with all that I know and that we've experienced, and the ups and the downs and the stress and all the things that have come along, we're human, right? You have those moments, you have those feelings of uncertainty, but every single time we've purchased something, we look back and go, boy, wish we had bought more.
You talked about making sacrifices to make this happen, and I think Steve's opinion is that you're not supposed to have any fun in life. You just pay off your mortgage, 100%. And then you can have fun when you're old.
You and my dad would get along really well, Steve.
I'm somewhere in the middle.
Young kids need to sacrifice earlier in life. That's all.
I'm somewhere in the middle. I think, like, be smart with your investments, but don't have no fun in life, because tomorrow is not a guarantee for any of us. And but you're obviously a very humble person, Chris. You've done very, very well in life. Didn't you make a sacrifice as you were doing this? Didn't you live like in a floor of a house, or like you've done this? How you got to here, right?
For sure. We and again, funny, and my dad uses these terms of sacrifice, right? He puts it in air quotes. You got to sacrifice, right? Because you're not
pretty good sacrifice.
You're not going to go to you're not going to take a trip to whatever. Whistler this year. You're not going to go to Florida. You're gonna put that money away for a few years, and so that's your sacrifice. Your lifestyle sacrifice is what you're choosing to do, or you're gonna buy a duplex instead of a really cool loft in King West in our marketplace, right? And I'm gonna go and buy a duplex, and I'm gonna have a tenant in one unit, and then maybe we're gonna add a basement apartment to it, and we're gonna to jack up the income there. And all of a sudden, now I've set myself up with a situation where my monthly overhead is paid for by my tenants.
Yeah.
Now, I'm not going to take that savings of that money that I would normally maybe pay for rent or my own mortgage that my tenants are paying for and go and buy a fancy car and a travel and all those things. I'm going to gather together that money, that savings, save more, and now go and buy the next investment property. And then as that property gets paid down, either sell it and reallocate those funds or refinance and now go buy another property. So those sacrifices, and my dad maybe will listen to this, I don't know, but I thank him for it. That guided me to where we are today. But the idea of this is, and he says, he actually said to one of my sons the other day, the whole idea is trying to create some, freedom for yourself, right? And so the sooner you can get yourself to a place that you can, have that sense of freedom to be able to choose what you want to do today. You're not like, I have to go to work because if I don't go to work, I can't pay for the basic needs of myself and my family. The sooner you can get to that, the better, more enjoyment in life you will likely have. And it doesn't have to be bazillions of dollars. I'm not talking about, massive, it has to be, hundreds of thousands of dollars.
Right.
But if you're getting to a point where you are, comfortable and you're able to live, that is really good. And so that sacrifice component, because of course with social media, my kids are 12 and 14. They're blessed with 2 boys, and with social media, they, you get to see fast cars and all these fancy things, and well, why not get a fast car? I mean, that sounds like a lot of fun, right? I mean, that's the first thing you want to do when you get your first job, right? Is buy a fancy fast car. Right?
My complaint is always like, people are like, you need to be happy. And they're always doing things to make them happy. And I don't believe happiness brings you happiness. I believe the pursuit of happiness brings you happiness.
I love it.
So I do think that it's not doing those things that actually fulfills you. It's doing all the work to be able to do those things that fulfills you. And that is... maybe it's just me getting older, which it probably is just me getting older. I'm just seeing less and less and less of that in the younger generation that doesn't want to sacrifice now to have those things to do older. So that's where Tom and I disagree, because he wants to have all the fun all the time.
No, I'm not even a guy that really goes out.
He doesn't do
anything.
anything.
You don't.
Yeah.
Well, and you're investing, like you're doing all the right things. And I think and it's a great point. And you see it today about, living for the moment. And I respect that tremendously. And Tom, to your point, I think you have to have some fun along the way. But Steve, on the other hand, like if you can get to the point where the pursuit of the goal is exciting as the goal itself, you will be I think you'll have a more enjoyable, journey along the way. And hey, life is short, and it's not perfect by any stretch. There's a lot of things, the bumps in the road that'll come, and tragic situations and exciting moments. But if you can get to that point where you're enjoying the pursuit of it, you've educated yourself to a point where you can appreciate what it means to buy real estate and what it looks like over time, as an example, or whatever your investment choice is, then I think at the end of the day, you're going to wake up, we're all, if we're lucky enough, we're, 20 years from now, we're all going to arrive at that moment. And the worst thing you could do is look back and go, gosh, I listened to that podcast. I listened to these guys talk about this, and I didn't explore it. First of all, explore the option.
Yeah.
I didn't take the time to really dig in. And here I am today, 20 years later. I remember that moment. I listened to that podcast on my way to work or on Sunday morning and having my coffee, and I didn't act.
Didn't take any action
right?
on it.
So That's all I'm suggesting. Like, is make sure you're making. So if you're saying, why buy? I'm going to wait to buy. Well, why? Just make sure your decision is based on fundamentals.
Right.
And I think that'll be a great story.
And I just want to wrap it up with, so when we talk about sacrifice, I think, how we look at things is really important. The Canadian version of sacrifice is, well, buy the 1+ den and rent out the den to your friend, or buy a duplex. What we would consider a sacrifice to get ahead is not that bad.
No, it's not that bad.
We are so lucky that we consider that to be the sacrifice, that we have the opportunity for that to be the sacrifice, versus what a lot of the world would call a sacrifice is, a whole lot different definition, right?
It's embarrassing.
And the act now thing is I just had it eternalized the other day because I just again, people are gonna get sick of me saying this, but I just started jiu-jitsu classes, and I was talking to one of the guys, and he's a higher level, obviously, because I had just started, and I was like, "Oh, when did you start?" And he's like, "Oh, I've been about 3 years ago," and I was like, someone had bought me a gift card for this gym 3 years ago, and I just had put it off, and I was like, "Man, I could be at that guy's level right now." If I had just started, and now I'm 3 years behind. And it's exactly what you're saying in anything, in education, in business, in owning real estate.
Chris, thank you. That was awesome. Like you've literally, I can show you the list. You're on the list. You've been on this list for a long time. Look, I'm actually going to show you. Okay. You've been on this list for a long time. Guess I'd like to be reach out to. Finally got you on the show.
Appreciate it.
Amazing episode. I really, really hope that the viewers and listeners really go back and even rewatch that 15-20 minutes on that conversation, because I think it could absolutely change your outlook and where you're going to end up in life. Really do truly mean that. If anybody made it this far that's not a homeowner, but, well, maybe a homeowner, but they're in the real estate industry, and they want to learn more about LePage Signature, the place that I've decided that this is where I work, this is where I do what I do, how would they reach out to you guys?
Well, I think they can follow us on social, and that's probably the easiest way. But reach out. You can call me directly. Just if you want to pick up a telephone. I don't know if people use telephones anymore.
It depends on the year they were born.
Yeah. In my generation,
voicemail's coming back, by the way, because the new update on the Apple phones. When you miss a call,
it transcribes.
It transcribes. So, like, remember the old days, your phone would ring and you'd hear the voicemail. You could pick it up halfway through.
Yeah,
you can do that now on the iPhones.
Oh,
you can
that.
interrupt the voice. Yeah.
Yeah.
That is so cool.
Yeah. So it's making a comeback. Yeah. It's making a comeback. Yeah. Thank you, everybody, for listening. Thank you for watching. Thank you to Realty Ninja for sponsoring this episode. Hope you enjoyed. If you have made it this far and you have not already, make sure to like this video and subscribe to the channel. We will see you next Sunday. Bye.
Thank you. That was
Chris.
fantastic.
That was awesome.